Hello, everybody, and welcome to the latest edition of the Property Chronicle podcast. Today, we are joined by Norm Miller. Norm is the Ernest W. Hahn Chair of Real Estate Finance at the University of San Diego. Norm Miller, thank you for joining us on the Property Chronicle podcast. It's great to have you with us today.
My pleasure.
Norm, I'm really excited to speak to you. I want to tap into all your deep expertise, so I'm just going to jump in with a big question to get us going. Does the US have a housing affordability crisis?
You know, it's such an interesting question because to somebody like myself, I'm now in my 70s. I've heard that we have a housing affordability crisis for the last 50 years. And of course, when housing really was affordable, the media never came out and said, by the way, 2020, it's super affordable almost everywhere. Maybe not a few markets, but most markets. So we should put in context that this is a continuation of a long-term extreme view that we always have an affordability crisis. And one of the things I like to point out in cities like mine, I'm in the San Diego metro area, and other cities like this that have seen large price gains. One of the reasons we have an affordability crisis is because of very successful economies. So, when San Francisco has a very successful economy, it becomes unaffordable and it's demand driven. And that's always going to be the case. So in some ways, it's a good problem, right? It means that the economy in San Francisco, San Diego, and other markets where they've seen price growth have done well. So, do we have an affordability crisis? I would say it's worse in 2024 simply because of the higher interest rates. And interest rates, as you know, Chris, are cyclical. But I expect that successful cities will always have an affordability crisis.
Right. Or at least at some point in the cycle, right? So, I think back to 2016, 2017, people were starting to challenge the narrative around superstar cities a little bit because of affordability issues. And at the time, my answer was, well, they're called superstar cities for a reason. They're doing really well. When you get to a strong part in the cycle, affordability is going to kick in. But as is so often the case, I feel like real estate research is about pulling apart what's cyclical and what's structural.
Yes.
Right. And there clearly are arguments that there are some structural issues in some markets, but a lot gets hidden by averages. Right. So housing affordability is an issue for some people for sure, but it's how you develop a holistic view. Tell me what you think about what data you should look at to form a holistic view.
Well, in terms of data, you brought up averages. The Case-Shiller index is one that's popular, but it's really interesting that 2005 to 2011, the average home price in San Diego County went down 35%. However, if you look at it submarket by submarket or neighborhood by neighborhood, the South County neighborhoods went down by 60%, and the North County neighborhoods went down hardly at all. And the average was, 35. It's fairly meaningless for somebody in a particular neighborhood. That same analogy can be brought forth to every metro in the entire world. You're going to see those kind of variations where real estate is quite different at the local level. So I'm not fond of averages if they're at the metro level or above, or state level, or national numbers. If you use statistics to estimate things like how many testicles do humans have, the answer would be 1 if you took those kind of averages. But if you don't filter by gender and you don't filter by submarket, you're missing the picture. And with real estate, we definitely need to drill down. So I trust local, very, very local data, postal code level data if you can get it, but neighborhood level data. And, there's 75,000 neighborhoods in the U.S. I bet there's 30,000 in the UK. And that's the level we should analyze, because now we can get that kind of data.
Right. Very good. And how do we develop a more holistic view of housing costs? I mean, we typically hear median income versus median rents or median price, but that only tells us part of the picture, right?
Yeah, we should definitely not use the realtor index that is based on median price and median income. We should look at what it costs to really own a home. So what do you have? You have a mortgage payment, which is a function of interest rates. So interest rates matter and prices matter. We have property taxes, which they range from 0.25% of the home value all the way to 4%, 5% of the home value, depending on your market. So you can't ignore that. In markets like Chicago, 2.1%. Markets in New Jersey could be 4%. It could be more than your mortgage rate. There's people in New Jersey that are paying 2.75% mortgages and 3% property taxes.
Wow. Yes.
So we definitely need to consider that. Third, if you live in Florida and any kind of market on the coast, you need to consider property insurance. So I would say that would be your third most important factor to consider in all markets, would be property insurance. And that would be my minimum for a housing affordability index. If you're talking condominiums, you probably need to include the HOA fees, because there is a lot of variation there. And that gets down to the specific local building almost. But with the mortgage interest rates, property taxes, property insurance would be a minimum for any kind of affordability index.
Right. Okay. And so do you have any insights as to how such a measure would change our view of regional variations?
Well, markets like California, where the realtor index is going to show it's very unaffordable because of price, are going to look better compared to markets like Florida because of the property insurance impact, if you would incorporate that. And, so markets like New Jersey, that might look good because of price, or Chicago, compared to San Francisco or San Diego or LA, they're also not going to look as good when we consider property taxes. So it's going to even things out a little bit and explain the market a little bit better to us. It might even affect some of the migration rates when people realize that, oh, gee, I moved to a great place in New Jersey for a bargain home price, but wow, look at what I'm paying in property taxes.
Yeah, well, I was going to ask you, do you think that a better affordability measure such that you have described would better explain existing migration trends, or do you think that the lack of transparency means that that's not the case, and perhaps people make decisions without the full information?
It's a great question about how informed people are, and I think that historically people have not put enough emphasis on property taxes when they buy property. They just kind of assume it's the same everywhere or fair. And it's not. So I think that more disclosure of that would be helpful to the market. I'm not sure how informed the market is, or how many home buyers looked that up. There's also legacy effects. Some markets where it lags because of regulation. California, Florida, they have regulations that hold down the increase. That can be a benefit to existing residents. And when we talk about affordability, existing residents may have really affordable homes because of legacy interest rates, legacy property taxes. And so what that implies is that our housing inflation rates that we use and feed into the CPI are dramatically overstated compared to the real underlying cost of that stock.
Right.
So that's another bias that we should keep in mind.
I expect a lot of home buyers are quite short-sighted about insurance costs as well. Or, you see some commentary which just suggests that recent increases are a temporary phenomenon or just hard for people to get their heads around? So,
yeah, I think the shock on insurance is different than it is on property taxes. I think on property taxes, they generally don't do enough research. I think on insurance, it's a mega shock of, every single friend that I have that lives in Florida is complaining about how their insurance costs have doubled or tripled in the last several years. And they don't feel like moving out of the state, but it's a huge burden. And so it's sort of caught up from behind. And I think that what that tells you clearly is that property insurance has been underpriced for years. We haven't taken the natural disaster risk seriously enough.
Mm-hmm.
The properties within the national flood zones within the U.S. have been dramatically underestimated. And they're being expanded and corrected. But that national property insurance was also dramatically underpriced. And so taxpayers have been subsidizing those homeowners. That subsidy is going to go away at some point. And as it does, those home values have to come down. So we are going to see more impact on home values from insurance in markets like coastal markets of Florida, maybe even some of the East Coast in New Jersey, a few places in California, but we have a steeper coast, so not quite as much exposure. But a lot of Florida is going to be priced out. And meanwhile, people are still moving to Florida.
Absolutely. Yeah. I think it's a great example of persistent inefficiencies in real estate. Those assets are mispriced.
I did some personal research on who's buying in places like Key West, and it's interesting to find stories. And there's this coach, Jim Johnson, who was down there in Key West, and his home is damaged. And they said, "Are you going to rebuild if your home is destroyed?" And he said, "Well, I have to. It's my home." Or they say, "Mother Nature's not going to beat me." So this kind of attitude totally perplexes me. I don't get it.
Yeah, me neither. What about on the other side of the coin? Do you think some more climate resilient cities or even neighborhoods might be underpriced at present?
I don't know the answer, but when we see people moving away from the less resilient areas, they're going to have to move somewhere. So nearby, adjacent, second and third tier cities are going to benefit, just like they have from the work from home movement, leaving San Francisco to go to second tier cities. We'll see the same thing as a climate rebound at some point. I don't think that's happened yet, but just wait till we have another Katrina that does a lot of damage. It might wake up a few more people.
Yeah, I'm sure you're right. What about on the institutional side of things? When institutions are buying either apartments or single family rentals, do you think there's more sophistication there when assessing climate risk?
I think there is more sophistication. We have First Street, we have Jupiter Intelligence, we have a lot of good data sources now that are providing site-specific climate risk. And I think the larger buyers are more aware. Now those larger institutional buyers probably have more to fear from regulations and, affordability, progressive advocates, naive as they are, that are blaming every big, deep pocket they can find for affordability, despite the fact that these institutional investors only own 3% of the inventory or less. And so I would have more fear on the institutional side from regulation and anti-deep pockets than I would from the climate risk. But I do think that they're more sophisticated buyers, yes.